Hello and welcome to lesson number 6. This is the final lesson in the course, and what we're going to cover today are various examples of the different conditions that we find in the market and show you how to interpret what's going on behind the scenes using all three of the tools that we have at our disposal. Now, the market is in a constant state of ebb and flow, presenting good and bad opportunities, and to be a successful trader, you need to be able to read those conditions the same way that one might read a map. So the aim of this lesson is to show you how to use the full suite of level 2 analysis tools to understand what's happening so you can then make profitable decisions about where, when, and how to trade. To begin with, let's start with some facts. These are tools that display information. They measure specific metrics in the market and show you a visual representation of those metrics. That's really no different to what a price chart does. A chart shows you what the current price is and when it changes. So that's a particular type of data that's being measured. Our tools are looking at a different set of data points and then visually representing that for you. And we get lots of questions from people asking things like, what's the win rate with these indicators and how much money do they make and so on. Well, these tools don't have win rates, nor do they make money, because they don't trade, and nor do they tell you when or how to trade. Questions like that, I think, are a little bit like someone asking, what's the win rate of a chart? Or thinking about other tools, perhaps maybe asking how quickly a hammer can build your house. These tools give you information. How you use that information and the actions that you take are what determine things like win rate and profitability. A tennis racket is a tool, but having the most advanced racket in the world won't make you a champion player. If you don't know how to play tennis, I may as well give you an old leather shoe, because the tool is useless in your unskilled hands. And that's exactly true for these tools. By themselves, they are of no use to you if you don't know how to trade and you don't know how to interpret that information properly. That's the reason that we've spent time in this course teaching you what is going on behind the scenes so that you are better able to understand what you're seeing and what it means. And it's the reason we're going to have such a comprehensive lesson today. Today is specifically about using these tools correctly and reading the information accurately. I know this is all probably obvious to you, but you'd be surprised how many people are naive enough to think that an indicator is going to miraculously make up for their poor trading skills. Okay, so that's the first thing. Please remember it. These merely give you information. It's more accurate and better information than any other tools out there, but it is still only information and it requires you to act on it properly. Now, the second thing is these tools are not showing you every single piece of order information. Now, the dashboard is looking at 100% of the price and the tick data for every single currency, as is the bid offer indicator or the bid and ask indicator. However, the core volumes indicator is looking at 53% of the customer side orders. Remember that the orders submitted exclusively in the spot market, not in the swaps or futures, are not visible. Not to anyone. Even banks and hedge funds can't see those orders in the spot market, and therefore this is not infallible and it's not 100% predictive or accurate. And with that in mind, you also have to realize that anything can happen at any time. Just because buying demand outweighs supply and the price is going up, that doesn't mean that it's guaranteed to stay that way. All it takes is for one big customer to come into the market in the opposite direction, or for a piece of news to come out, and the conditions can turn in a heartbeat. Most of the time, the market is just random noise. It doesn't matter what information you have or what tools you use or the system that you employ, you still have to be patient. The point of advanced institutional tools like these is that they allow you to identify the most profitable conditions and separate the signal from the noise. And the best conditions are not as numerous as the worst conditions. So you have to be patient and use these tools to find the right conditions before you act. There's a common misconception, I think, amongst new traders that they can take trades whenever it suits them, but that's not how it works. The market doesn't bend to your wishes. You have to work with what the market gives you. So this isn't like other jobs where you can sit down and just get busy immediately. It's more like fishing, where you can go to the water and throw your line in, but then you've just got to sit there and wait for something to come along and bite your hook. And some days, nothing bites. And that's why the aim of this lesson is to teach you how to read the market order flows in order to interpret the conditions accurately and then help you make better trading decisions. Okay, so with some of that common sense lecture over with, let's start with an example. Now, it doesn't matter what style of trading you're doing, intraday or long term, you really want to see what the conditions are like during the financial session that's running the show at the time that you're considering entering. So if you're trading when the London banks are open, you want to adjust the settings to look at the London market. The London banks start work at 8 AM local time. So you set the session strength box to that time, and that will then track everything that happens to each currency from that point on. You'd also set the session liquidity box to look at the London morning, and that will tell you the liquidity conditions across the entire market compared to what's normal for the London morning. And if you're trading during New York or the Asian banking hours, you would just set these sections to meet those times. The rest of the settings depend on what you want to see. You might want to compare today against the longer term trends, in which case you may set the other boxes to look at higher time frames like days, weeks or months. Or if you're particularly short term focused, you could set these to look at something like the last hour and the last 10 minutes to give you an intraday perspective. It's up to you and how you trade. Now, I will come back and refer to the dashboard, but I'm not going to go into too much detail now because we covered the basics in lesson 4. So you know the general patterns and what they mean. But moreover, it is such a comprehensive tool with so many options and uses, it's too much for a single class like this. And we've actually got an entire training package for it if you choose to sign up and subscribe to it after this course. So let's just assume that we've identified a couple of currencies on the dashboard that we're interested in. And now we'll take a look at the charts to see what the core volumes and the bid-ask indicator tells us. You already know that a price chart by itself is of no real value. However, that's only by itself. Price is one of the most important indicators that we have when it's combined with order flow data. So let's start by sticking to what we know for certain, and then we can build the full picture. The core volumes indicator tells us which side the customer orders are most dominant on. So blue means buy orders are more dominant, and red means sell orders are more dominant. And the size of the bar tells us by what proportion. If it's at 0, there is no imbalance. If it was 100, it would mean 100% of the customer orders were buy orders or 100% were sell orders. So if you saw a bar like this at 50%, it means the volume of buy orders are twice the size of the volume of sell orders. Now, of course, it is also measuring open interest and institution type, and those measurements add or subtract marginal amounts to the size of these bars, but the vast majority of this indicator is calculating the raw customer volume imbalances like this. But if the volume of buy orders are twice the size of the sell orders, we don't actually know from looking at the indicator what those specific volumes are. It could be 2 million versus 1 million, or it could be 20 million versus 10 million. And that makes a huge difference. If the market looked like this, with 2 million of liquidity at each level either side, well, the sell orders would be absorbed by this market making bid because it's only half the size of what is available there, and the buy order will only consume one market maker offer. Despite having a 50% imbalance between the customers' buying and selling volumes, the price only moved one level because the total order sizes were small and way below the supply of liquidity. Market makers wouldn't pay much attention to that. They might fill that gap with an improved bid, or they might fill it with an improved offer. There's no real customer demand in either direction there, is there? Whereas if the situation was this, with 20 million versus 10 million, well, that's entirely different. We still have a 50% imbalance, and the indicator will still display the same size blue bar as before. But look at the market mechanics now. The sell orders consume 5 levels of bids. The buy orders consume 10 levels of offers. So all of a sudden, customer demand is far exceeding the supply of liquidity, isn't it? In both directions in this example. And we'll come back to how market makers respond to this kind of situation. But for now, the point that I'm making is that volume imbalance percentages alone doesn't determine if the price will move. It's the actual size of the orders. The orders have to be big enough to consume the liquidity. Demand must exceed supply. So don't think that seeing a big core volume bar like this is enough by itself to tell you what's going to happen with the price. We've also got to factor in what the market makers are doing. And we talked about this in the last lesson, so again, I don't want to repeat it too much here. You already know the bid-ask indicator shows us whether market makers are adding liquidity below or above the price. But just like the core volumes indicator, this is telling us the imbalance in liquidity. It's not telling us the total volume of liquidity. A green bar shows that they're adding more liquidity below the price than above, and a red bar means they're adding more liquidity above than below. So we can see the imbalance in their supply, but we don't know if they're adding an extra 1 million at each level or if they're adding an extra 5 million at each level. And of course, that matters. The amount of money involved matters. So making sense of both of these indicators properly and actually being able to read what's really going on, we need to look at the price bars as well. Price by itself may not be much use, but comparing it to customer volume imbalances and liquidity imbalances, now all of a sudden you have something that is extremely informative. So take this example. Here we've got a big core volumes bar. So we know there's a big imbalance between the buyers and sellers. We've also got a green bid-ask bar. So we know there is less liquidity above than below, and therefore the conditions are good and correct for the price to move up more easily. And we might expect a decent move up. Yet if we look at the price bar, it's quite small. Now that's important information and it tells us a lot. All other assumptions and speculation aside, we know for certain in this situation that total customer demand can't be much greater than total liquidity supply. It may be that the customer orders are simply quite small and normal levels of liquidity are enough to absorb them. Or it could be that liquidity is bigger than usual at each level. And even if the customer orders are quite big, the liquidity is still big enough to keep up with that demand. It doesn't matter what the exact reason is. The one thing we know for certain, looking at this example, is that demand is not that much bigger than supply. It can't be, otherwise the price would have moved more than it has. Now, the opposite situation to that is we might have a small imbalance in the core volumes and the bid-ask indicators and a big price move. And what we know for certain in that situation is demand must now be exceeding the supply. We don't know whether it's because the customer orders are absolutely massive or if it's because the liquidity is particularly small. But again, it doesn't matter. Let's just stick with the facts. Customer demand must be significantly greater than the supply in that direction. So let's look at how these three things build on each other. The core volumes indicator, looking like this, tells us there are more buy orders than sell orders. There's an imbalance between the customers and what they're demanding. The bid-ask indicator, looking like this, tells us that market makers are adding more orders below the price than above, and there's an imbalance in the supply of liquidity. Put those two indicators together and we can see there is an imbalance between supply and demand. Now add in the price bar and the picture is even clearer. It tells us how big the supply and demand imbalance is. A small price bar means the imbalance must be small, whereas a large bar means the imbalance must be big. Can you see how you've got much more informed perspective about what's going on when you look at all three of those factors together? In terms of the order in importance, the core volumes is by far and away the biggest factor to take notice of. Besides the main dashboard, I think this is the most significant thing more than anything else by a long way, and you will learn to rely on this indicator quite a lot. Then I think it is the bid and ask indicator, and then lastly, it's the price. But assessing all three relative to each other is what really gives a much clearer view of what is going on behind the scenes and will allow you to make more profitable decisions. The more information you have, and therefore the more you understand it, the more informed you are and the more money you are going to make. If we've got a blue volume bar and a green bid-ask bar and a good-sized price bar, we know demand is significantly exceeding supply, and this is a good move. If we've got a blue core volume bar and a green bid-ask bar and a small price bar, we know that demand is only slightly exceeding supply, and this is not such a good move. So what we really want to look for is this: customer imbalances, liquidity imbalances, which together means we now have supply and demand imbalances, and a big price move. And of course, there's a sliding scale for those good conditions. The bigger the core volumes bar, the better, because it means a much bigger imbalance between buyers and sellers. The bigger the bid-ask bar, the better, because it means there's a bigger imbalance in liquidity supply, and a bigger price bar means a bigger imbalance between supply and demand. The more extreme each of these elements are, the more favorable the conditions are. This is good, but this is awesome. Now, Just like we shouldn't look at any of these indicators in isolation, we also shouldn't look at these conditions in isolation, because these patterns will mean something different depending on what's been happening previously. For example, here we've got a good core volumes bar and an aligned bid and ask bar, but a small price bar. Now, in isolation, we can say that the total supply and demand imbalance is small, and therefore we don't want to take much notice of this, as we've just been talking about. But what if this is what the market looked like leading up to this? There's been no significant imbalances on the customer side, with nothing going above the threshold, and they were changing colour frequently. And the bid-ask indicator was also very inconsistent as well, with only small imbalances and frequent changes back and forth between the colour. So this is an indecisive, sideways, probably random market. But the pattern that we've been discussing in isolation stands out, doesn't it? This is different to what's been happening previously. For the first time, both indicators have significantly large bars, and they are both aligned. So at the very least, we can say this is a change in the conditions behind the scenes. Now, the price hasn't moved yet. It's not really any different to the bars before it. So we know the total supply and demand imbalance is not yet significant. But customer behavior has changed, as has the market maker behavior. So that's an early warning to tell you to sit up and take notice. Conditions are changing. Imbalances are changing. There's a very good chance that you are about to see a price change as well. Remember that these are leading indicators. Customers and market makers' orders interact first, and then the price moves. Now, let's take exactly the same isolated situation, but this time there's been a big trend preceding it. The conditions leading up to this are good and what you'd expect. Good customer imbalances, good liquidity imbalances, and good size price bars informing us that demand is significantly exceeding supply. And now this. Again, this stands out as different, doesn't it? With more or less the same levels of imbalance on the customer and liquidity sides, all of a sudden, the price fails to move very far. This price bar is about a quarter the size of the 7 bars that were before it. So immediately that's telling us there's a change in conditions. And the change is that demand is no longer significantly exceeding the supply. The existing condition is that of a trend. This is a changing condition, and therefore this could be the end of that trend. This would be even more significant if we also saw the core volumes reduce in size or switch colour, or if we saw the bid-ask indicator switch colour, telling us that market makers are now beginning to supply more liquidity above the price. Can you see how it's the context that matters? We can look at isolated snapshots and determine what the conditions are there and then, but it's only when you put that moment in time into context to the preceding conditions that you can really appreciate the significance. This condition can signify the start of a new trend under these conditions or the end of a trend in these conditions. So the big picture matters, and all of these tools, when used together, give you that big picture. And something we haven't looked at yet is tick volume. Let's say we have this situation, again, with good customer imbalances, good liquidity imbalances, and a good price move. So we know that demand must be significantly greater than the supply. These are certainly good conditions right now, but this is only a snapshot in time. How do we know if these conditions are likely to continue? Well, tick volume gives us a very good indication. Remember that a tick is measured every time the price changes up or down, and the price will only change if there's some activity on that pair. So tick volumes are really an indication of order activity levels. The more ticks that are counted, the more activity that there is. So if we see this move, but it's accompanied by low tick volumes, we can conclude that there isn't actually a great deal of order activity. The imbalances may be significant, but if the total number of people trading here and the total number of their orders are small, there's not much chance of the price going much further. Never forget that it takes money to move the market. As a very, very general rule of thumb, the level 2 market depth that we see here has, on average, around $1 million at each level. And there are 10 levels in every pip. So as a rough guide, it takes approximately $100 million to move the market 10 pips. Now, that obviously depends on the pair that you're looking at and the time of day, but that is a reasonable guideline to work from during normal trading hours. So low tick volume means less activity, which means fewer traders are interacting here, which means less money and probably a shorter lived move. Whereas high tick volume means more activity, which means more traders are busy and interacting, which means more money and probably a much better chance that this move will continue further. And we've got a trick. And we've got a great tick volume indicator that will also put everything instantly into context. On the main dashboard, we can see the tick volumes for 3 different time periods, and then we can make a direct comparison. So on the left, it tells us what the average tick volume is for the session that we're trading. So for me, this would be the London session. Then I can set the other 2 columns to anything I like. And maybe as an intraday trader, I want to see the last 1 hour as a kind of midterm condition. And if I trade using 5-minute charts, I might want the right column to show the most recent 5 minutes. And look at how this would help you. So here's our chart condition again. It all looks pretty good, but we want to know if this move is likely to continue or not. So we look at the level of order activity that is accompanying the move. If the activity right now is going up and it is above average, either above the average for the session overall or for the conditions in the past 1 hour, we can say that this is a good move. Increase in tick volumes mean increase in order activity and most likely more traders and more money coming into the market. But if on the other hand the tick volumes were low and well below average, well, in that case, this is probably not a great move and it's probably not likely to continue. There just isn't enough activity to keep this going. So can you see how easy this is to properly understand and interpret what's going on? I know, yes, there's a lot of elements to look at and consider. It certainly requires a lot more effort than merely sticking a moving average on your chart. But there's no comparison in terms of what you can see and how accurate you can be with your trades using this. You have got a complete picture of what's going on, who and what is driving the market, and how likely a move is to continue or not. So this is how you make money, easily. Just look at this chart. It's been fairly sideways, perhaps with a small uptrend and slight overall imbalance to the buy side on the customer orders most recently. Not a great deal of consistency with the market maker liquidity imbalances, no significant price moves, and tick volumes are lower than they have been on average in the last hour or this session so far. So there's no reason to be very interested in trading this. But now look at the conditions as they begin to change. The customer volumes switch from buying to selling imbalances, and the proportion of that imbalance is fairly big above the threshold level. We know the volume of buy orders must be greater than the sell orders. The liquidity imbalance is also aligned, and the imbalances are bigger than they previously were, which means market makers are putting more new orders above the price than below it. And we have confirmation with the price move. The price bar is bigger than the previous 8 or so, which tells us that customer demand must be exceeding the liquidity supply in that direction. I know this price bar isn't huge, but proportionally it is 2 or 3, even 4 times bigger than the bars that were immediately preceding it. But it's the core volumes and the liquidity that really stand out as the change in conditions. And then when we look at the tick volumes, we can see that the activity now is higher than the past hour and the average for the session. And that means there is now greater order activity, probably more traders and more money. And therefore, the likelihood that this move has some power behind it is very likely to continue, at least in the short term. And from there, it did just get better. The core volumes increases in size, meaning more and more new sellers are joining the move. Liquidity imbalances increase, meaning market makers are improving their offers above the price while the bids are being removed below the price, and the price bars are bigger, which you would expect with these kinds of imbalances, and the price is moving in the direction of least liquidity or in the direction of least resistance. So demand is significantly exceeding the supply. And throughout this, the tick volumes remain high and increasing, which means the total order activity is high. There are more traders and more money sustaining this move down. Now along here, although the core volumes drops a little bit, they remain high above the threshold, and it's not unusual to see the biggest imbalance at the start of a new move, and then it settles down to a more consistent level during a steady trend like this. But they've stayed high, and there's nothing to say the imbalance is changing. Sellers are still far outweighing buyers. And liquidity also remains consistent and steady. It's only down here that we begin to see a change in those conditions. There's a fairly big spike up in price, so that is not consistent with the trend. Now remember that anything can happen at any time, and it only takes one big customer or piece of news to hit, and the market can change in a heartbeat. Also remember, we can't see every order. So this may actually be the result of an order that we can't track. But liquidity remains consistent throughout all this, with more new orders above the price than below, which makes a move up in price much more difficult. And customer sell orders are still greater than the buy order volumes, albeit the imbalance was smaller, but that spike didn't actually do very much when you look at those conditions. This isn't a reversal in the market, but we can see changes in conditions. Customer order imbalances are low now and below that threshold. The price is no longer aligned with the imbalances, which tells us demand is no longer consistently exceeding the supply, and the tick volumes have now dropped off. So it's over here that we get much more clear confirmation that that trend is over. And we then see the price begin to move up, and some of these price bars are actually quite big. However, liquidity imbalances are back and forth, and therefore they're not consistent. The customer volumes are imbalanced to the buy side for a time, which you would expect when the price is moving up, but they are mostly below the threshold level, and the tick volumes are low, which tells us that the total order activity isn't very good, and the move is therefore a lower probability. Along this whole period, there's a complete disalignment between the customer imbalances and the liquidity. So this is a much more random and disjointed market. But now look at this. The customer imbalances switch to buying, and significantly, and at the same time, market maker liquidity jumps right up. The price is now confirming that demand is exceeding supply because this is a reasonably big bar, and tick volumes are suddenly higher again. So now you've got total alignment between all these indicators once again. And look at the move that follows. Just like that downtrend earlier, the core volumes increase and remain consistently high above the threshold. The same with the liquidity imbalances. Tick volumes are high and increasing, and the price bars are big and getting bigger, confirming that demand is indeed exceeding the supply by a significant margin. It's then only up here that we begin to see a change in those overall conditions. Liquidity imbalances remain heavier under the price than above, but customer volumes drop so that the imbalance is below the threshold and therefore not really that imbalanced at all. And perhaps more obviously, the price is no longer rising, which means demand is no longer exceeding supply. And if we look at the tick volumes, they've also dropped, which means the order activity has now fallen away. So again, this is a change in conditions compared to that trend. But what about this new push up in price? Is that a continuation of the trend? Are we going to see another move up? Well, the customer imbalances only rise slightly, so they don't seem to match the size of the price move, and the tick volumes are still small. What that means is, yes, demand clearly exceeds supply, or else we wouldn't see a price move up like that, but the actual numbers involved are probably small and probably not going to last. There isn't a lot of money behind this to sustain it. And you can see that the next price bar is much smaller, customer imbalances drop off really quite a lot, and tick volumes are now even lower. There's certainly nothing to suggest a continued move up, and a lot to suggest that this is the end of the move. And the very next price bar is actually a really large down move. Now, is that a breakout to the downside, perhaps? The start of a new downtrend and you should stop and reverse, something that you want to react to and get involved in? Well, demand clearly exceeds supply to the downside, or else the price wouldn't move. But customer sell order imbalance is tiny. Buyers and sellers are almost equal there. Market maker liquidity is still heavier below the price than above, and the tick volume is still low. So there's nothing to even hint that this is anything other than a short-lived random move. Volatility or perhaps a bit of news. It's definitely not a high probability move. And if I fast forward to reveal the rest of the chart, you can see what then happened. There was no downtrend, nor any further uptrend, and a pretty uneventful sideways market, just like the period that we saw earlier. And if you just step back and look at that full chart, which parts stand out as obvious? The two trends earlier really stand apart, don't they? And we don't just looking back with hindsight here. The conditions that started those trends were obvious immediately at the beginning of each of those moves. We saw a sudden change in the conditions before any trend was apparent. The strong trends happened because all of the indicators were aligned and the conditions and imbalances on each indicator were large. It's not just changes in color that we're looking for, it is big changes in those bars and the colors and the big price moves and big tick volumes. We're looking for big activity. And similarly, we saw the end of the trend when we saw a big significant changes to those conditions. There was a big drop in the size of the bars and a big drop in the tick volumes and a big drop in the price moves. And hopefully you can see that it's quite easy to read the true market mechanics and the workings of the market with all of these tools in front of you. You might see one or two elements that appear good, like a big price move or a big imbalance somewhere, but you won't get drawn into a false or a low probability move because the other elements aren't aligned yet. You can see whether a move is good or high probability or not by waiting for all the elements that interact to become aligned and really stand out as something different. They should look quite obvious to you. And the analysis that we've done briefly on this chart, you can do with every chart. And most importantly, you can do it in real time. Every price move that you see, you can quickly assess whether or not you've got full alignment with all of the component parts or not. And you'll know instantly whether you're looking at a high probability or a low probability move. And armed with that knowledge, you can make the decision to trade or not to trade. Yes, this requires work and effort on your part. You are not sitting back and waiting for red and green lights to tell you when to trade or what to do. And nothing is going to do the work for you using these indicators. You've got to engage your brain and assess the information that you're looking at. But hopefully you can see how simple this can be, and more importantly, how effective and profitable it can be. You are never going to be able to achieve anything like this just by looking at a chart. And I hope this course has adequately shown you what to do and how to do it, and has excited you about the possibilities with all of this at your fingertips. We get a lot of feedback from people taking this course, and overwhelmingly they tell us that they've learned more from this than anything else they've done before in trading. Hopefully you feel the same and you've seen enough to want to use these tools for yourself. And this is your chance to tap into the same data as top-level financial institutions for yourself. As I've said previously, this is the biggest game changer that I've ever seen in Forex. And I know terms like that are thrown around all the time with overhyped marketing gimmicks, but this genuinely does level the playing field. You are assessing the same data as hedge funds, so you now have the same advantage of them. So we've got two options for you if you'd like to take advantage of these tools. You can either subscribe to our Level 2 analysis package, which will let you trade manually and use these tools for your own systems and your own strategies. So this is ideal if you want to be in control and you want to do things yourself. And actually, this is what I would recommend, because I do think you should become the master of your own trading. However, there is also the option to sign up for our robot, which is a brand new advanced algorithm that will trade the market using these tools on autopilot for you. So this might be the better option if you are perhaps a newer trader or if you don't have much time available at the moment. And I'll explain each of these packages separately, starting with the manual tools package. You get the core volumes indicator that shows you the real-time buying and selling imbalances of the customers that are driving the price moves. Remember that this not only shows you whether buyers or sellers are dominating the move, but also who those buyers and sellers are and when open interest is increasing or decreasing. You'll also get the bid-ask improvements indicator that shows you what the market makers are doing and whether they are being more competitive on the buy or the sell side. So right there, just between those two indicators, you can quickly and easily see both sides of the price equation. You're seeing what the customer orders are doing, what the market makers are doing, and consequently, you're seeing exactly what is moving the price and which direction it is most likely to go next. Now, that by itself is an inside view of the market that other retail traders have never had access to before. Obviously, hedge funds and other top-tier institutions have been using this information for decades, but I think this is like a crystal ball compared to what retail traders have been used to until now, because this data has never been open to the public before. But on top of that, you are also going to get our advanced market analysis dashboard. And this is the absolute pinnacle of full currency analysis. There is no other tool on the market that gives you such an in-depth and comprehensive view of foreign exchange. And all of this comes with additional video training courses as well to teach you in even more detail how to use each of these tools individually to the highest professional standards. With all of that at your fingertips, you will know exactly what is going on and why. Most traders look at a price chart and they have to follow it, never knowing why it moved or if it is likely to keep moving. Professional traders look at the order flows behind the price, and that's why they're often called the smart money. And the question every aspiring trader needs to ask themselves is if they want to be in the smart money group or in the dumb money. Do you want to be a winner or a loser? And I know that may sound harsh, but it is the reality of being a speculative trader. This is a really competitive field, and it is ruthless. It's not an occupation for the weak or the timid, and it is certainly not fair. Traders are in the business of taking money off other traders. And if you're going to try and compete in a cutthroat activity like this, you really only stand a chance if you equip yourself with the best tools that give you a real edge and a statistical advantage. You do not want to be that guy in the middle having his pockets picked by the professionals who are using better tools and have more information than you. The problem, of course, is this data is hard to get, it's very expensive, which is what makes it out of reach for typical retail traders. And you can check out this for yourself with the various exchanges, but if you look for level 2 order book data on the various aggregate suppliers, the cost runs from between $10,000 and $40,000 per month. So now you understand why it is only hedge funds that tend to use this. But as a professional trading firm, we can sign up to these various data providers, and we can cover the expense of programming to decompile that data and then translate it into easy to use indicators like these and pass them on. The obvious advantage for you is you can then use the tools which are 100% powered by this top level data feed without you actually having to fork out for the extreme costs of the data for yourself. You're getting all of the benefit without the expense. The core volumes indicator is available as a standalone tool by itself for $150 monthly subscription. Our advanced analysis dashboard and the bid-ask indicator goes for $200 per month on a monthly subscription. You can get the entire bundle with everything inclusive for just $199. So in effect, you're getting the core volumes indicator for free. And the reason we're doing that is because we believe in it so much, and we know that anyone who uses it will instantly improve their results. So we want you to get your hands on this because we know it will transform the way you trade from now on, and you will stick around on that subscription. Now, there are a couple of conditions with this. First of all, yes, you can cancel at any time for any reason. There are no long-term or minimum length contracts, but there are no refunds. You are paying for a license to tap into that tier 1 institutional data feed. When we give you a license, we have to pay that data provider upfront for the connection. And as I've already explained, that data costs in the high 5 figures monthly, and it can't be returned once it's used. So these indicators are for serious traders only. And for serious traders, $199 per month for access to this kind of data and this information is really just a drop in the ocean compared to the returns that it can help you achieve. If you don't think this is a steal and a once-in-a-lifetime opportunity, then I'm afraid this service is probably not for you. As I said, you can cancel the subscription at any time. If you don't like the service or the tools, you can cancel instantly and easily. You can walk away and you will not be billed ever again. There are no long-term contracts or minimum subscription periods or anything like that. You're under no obligation with this, but you won't be refunded for any previous months. A couple of other points. For now, the core volumes indicator and the bid-ask indicator are both only compatible with the MT4 trading platform. They are currently being coded for use with MT5, NinjaTrader, and TradeStation, and we plan and expect to actually have them ready for you in the next couple of weeks. But right now, they only work on MT4, so please check that your broker offers MetaTrader 4 as a platform before you subscribe to this. The main analysis dashboard, that's a standalone Windows desktop application, so it's completely independent of a trading platform, and you can use that on any computer. It makes no difference what broker you use. If you use a Mac, it will work as long as you have the Windows partition that Apple provide. The core volumes indicator is also linked to a specific MT4 account number. It will only install and work on the MT4 account that you link to your license key. So when you sign up for this, on the thank you page, you are going to be asked to enter your MT4 account number, and that will be encoded into the license for you. Please make sure you have that ready before you go through the order link. Now, you can change that whenever you like. If you're using a demo account right now and you want to change to a live account or any other account later on in the future, you can. So don't worry about that, but just be aware that to get started, the indicator is linked to a specific account, so you will need to let us know which account you want this to work on. So you probably just want to get on with this instead of listening to me talk about, and this package is the one you want if you want to be in control of your own trading, doing your own analysis and making your own trading decisions using whatever system you prefer to use. If that's you, All you've got to do is click the link below this video and you can get started straight away. You should be watching this in the members area and you'll find an order link below the video on the same page. So you'll be signed up to a recurring monthly subscription that, as I said, you can cancel at any time for any reason. You're under no obligation or contract to stay with us if you don't want to. Although I think once you've seen this in action and you've been using it for a few weeks, I can't really imagine any reason why you would ever choose to go back to trading without it. It'd be like going back to having, or from having insider information, going back to trading with a blindfold on. And don't forget that you can use this with any system you like. These are analysis tools. So you can take any system you already have and apply these indicators to supercharge your results by several factors. It is just so versatile. It's got so many applications to all different styles of trading that you are going to love putting this to use and seeing what it's capable of. As I said, I personally think this is the most significant advancement in retail trading since the markets were opened up to us back in the 90s. So I can't recommend this strongly enough. It is going to make a massive difference to your performance and your results as it has to mine. But in case you are not at that stage yet of being in control of your own trading, we do have a trading robot as a second option. Now, this is brand new. It's something that we only released a couple of weeks ago, ready for 2019. Now, for a while now, behind the scenes, we've been developing and testing an algorithm that will actually scan the dashboard and the volumes indicator, looking for high probability patterns, and then take and manage those trades on autopilot. And just as a heads up, these are some of the results we've got from back testing over the last year, and just at a glance you can see that the equity curves are all heading in the right direction, which is a pretty nice thing to achieve considering you don't need to be sat in front of your charts all day. In fact, if I dare use one of the oldest marketing hooks in the book, you could have done all this while you were sleeping, which I say with a smile on my face because I know full well what a gimmick that is, but it is still true. If you live in the US and you want to trade the London session, or you're in Australia or New Zealand and you want to trade New York, well, that's the middle of the night for you. A robot can do that while you sleep. And no matter what time zone you live in, if you have a day job or other commitments, it can be really difficult to find the time to trade, no matter what. Well, a robot can be like your own employee, trading around the clock for you, whether you're sleeping or working or just relaxing. And even for people who do have the time, perhaps the more appealing thing about automated systems is they take the emotion out of trading. There is no fear or greed or revenge trading or hesitation and so on. When it sees the pattern, it takes the trade exactly as per the rules of the system. It never breaks the rules or makes any of the mistakes that humans make. And in that sense, it is incredibly consistent and accurate and reliable. So you can understand why this is one of the first things every trader asks when they find a profitable system or new indicator. Can it be automated? Because if it can, you have the epitome of autopilot profits and passive income that everyone dreams of. And I can assure you I'm no different to anyone else, and I've had the same desire since I first looked at Forex back in 2003. Last year, I made a total of 86% gain from my manual trading, where I was only trading for 2 hours per day during the London morning. If a robot could trade the same system to the same standard during the New York and the Asian sessions as well, and not stop for the long annual holidays that I usually have, well, the obvious potential is that those results are doubled or tripled, perhaps even more, without me doing any extra work. In fact, I don't even need to do the 2 hours a day that I currently do. Well, for the past 2 years, I have had a programmer working with me using all sorts of techniques like machine learning and artificial intelligence to create a smart algorithm that will trade like I do. To begin with, I think I should really stop calling it a robot because that is far too simplistic. This is an advanced and extremely complex algorithm that is carefully developed to try and replicate the best style of human trading. Now, black and white binary rules simply do not work very well for trading, whether that's for a robot or a human being. Now, don't get me wrong, we absolutely need rules, but we also need flexibility, which I would describe as the human element, that mix of intelligence and intuition. Currency markets are extremely complex and chaotic, and no two moments are ever identical because there are literally tens of millions of variables that are connected and interacting. So this is quite a normal pattern that I trade. I've matched a strong currency against a weak one, it's got momentum, the session liquidity is good, pips and ticks are all ascending. So all in all, that is typically a high probability trade. And that pattern can be quantified and coded mathematically into a robot. However, that pattern can appear identical on two separate days, but the situations are actually totally different. And on one day, you should trade, and on the other day, you shouldn't. Things to consider are, what's happened prior to that pattern appearing? What was the previous pattern or the previous market like? Is this the fifth day of an existing trend, or is it the first day of a new one? Is this pattern appearing just before or just after news, or has there been absolutely no news all day? Is this the first day back after New Year, or is it the day just before the Christmas holidays? Has there just been another Brexit vote or a terrorist attack, or perhaps Beyonce has just been voted in as the president? In other words, the pattern needs to be considered in context of the bigger picture of where, when, and how it appears. The pattern itself is actually not as important as the context or reading the wider market, and we've talked about this. And that's something that in the past, at least, has been very difficult to code into a set of rules for a robot to follow. It is also the reason that new traders fail, even when they are copying a rule-based system with patterns, because they actually lack the experience to differentiate between the subtle nuances in the market and look at the bigger picture. You do need human experience and knowledge and intuition. Fortunately, there have been huge advances in technology, and we now have machine learning. Not only can we code far more complexity into a robot in the first place than we could several years ago, but they can actually learn from the experience and remember what worked best in past conditions and apply that memory to trade better in similar conditions in the future. So let me show you how this works. The algorithm runs within our database, monitoring all that raw order flow data that we stream from those various exchanges that we're connected to. It looks at every feature that we have on the main analysis dashboard. So it's looking at the customer buy and sell order volumes, market maker bid and offers, as well as the price charts to check the spreads and the price movements and so on. And in total, there are 22 separate elements that are assessed in isolation. And this is where it gets complicated. It's far too simplistic to implement rules such as just make sure the currency is above or below the zero line, or there is a ascending pattern on the pips and the ticks, because each individual condition will of course sit on a sliding scale of quality. This strength and weakness is not as good as this strength and weakness. The momentum in this divergence is not as good as the momentum here. Now technically they are the same kinds of patterns, but in real terms of deciding whether to trade or not, if we were scoring the patterns on how good they were, some would definitely be better than others, even though they've all reached a certain minimum. And also, after applying the score to the individual patterns, we also have to consider how each element adds up in combination for a total score. For example, if a strong currency scored, let's say 100, it may be acceptable to match it against a weak currency that only scores 20 and has a correlation of negative 60. But if the strong currency was only at 60, the weak one might actually need to be at 40 and then have a negative correlation of 80 for the overall combination or the overall condition to be good enough. And that total combination, where we add everything together, we've called the threshold level. And remember, there are 22 different elements to consider. So if they're all midway, that could be good enough for a trade. But if some are particularly high, it might actually be acceptable for some of the others to be much smaller. Some factors are far more important than others. So if they are particularly good, it may be okay for some of the less important ones to actually score badly. And incredibly, even with only 22 individual factors that are being assessed, when you add up all the potential combinations, we end up with these many possibilities. Now that is 341 octillion, which is a number I'd never even heard of before, but it's the same as 341,000 billion quadrillion. In real terms then, it's not that there are 22 different patterns to look at and assess, it's 22 core patterns that then actually combine to create 341 octillion sub-patterns. And within them, some are profitable and tradable, some, perhaps the majority, aren't. Now, amazingly, with thousands of hours of chart time, so myself, for instance, with 15 years of trading, all that experience, the brain of a good human trader can make all of those calculations intuitively. Although you can certainly understand why a new trader with less experience would struggle to comprehend that. Now, programming all of that into a new robot has been complicated, but we have done it. We input a set of conditions that we think will work, including the minimum and the maximum scores and the thresholds, and then we test the outcomes on historical data. And then we can then look at each of those individual trades that would have been taken under those settings, and we can manually assess them and basically approve them or disapprove them. We can also tell the robot to look at the actual trades that I've taken over the years and mathematically score the market conditions at the time of those trades, looking back at all the data that we've stored, and then get the robot to remember those parameters. And we can also tell the algorithm to actually go looking for strong directional moves that have happened in the past that would have been profitable to trade, and note the conditions that immediately led up to that and during the move, so that it can look for similar conditions in the future. In other words, look for all the times that you could have made money and find the patterns that led up to that move, and then wait for the same conditions to happen again in the future. And that's the real beauty of machine learning. Once we tell it that a set of conditions are good, it remembers them and it will recognize them in the future. And over time, we can add more and more to its memory through a combination of backtesting and forward learning. So it will get better with time, just like a human trader. And because no two moments are ever identical in the market, the likelihood of the exact conditions that we identified from the past ever happening again are actually quite small. So to be a little bit more flexible and capture very similar but not perhaps identical trades in the future, we can tell the robot that if the pattern appears, but with a slight variance of maybe 1 or 2 points either side, well, that's good enough and it should take the trade. And what we end up with is a much more accurate and profitable robot compared to a normal one. Let's say these are all the possible outcomes in the market. A normal robot will define a broad set of rules that attempts to capture the majority of the profitable trades within one particular type of market condition. So it's a bit like putting a large umbrella over a good set of variable conditions or favorable conditions. The trouble is, mixed in with that are a lot of bad trades. And I don't just mean losing trades, which no one can avoid. I mean trades and conditions that no one in their right mind would ever want to go near. But if a normal robot tries to filter out bad trades, it inevitably also filters out a significant number of good winning trades as well. And on top of that, there's always going to be a significant number of profitable trades that fall well outside of the reach of the robot's umbrella of conditions. These market conditions may actually be totally different from the first set, and the robot isn't coded to even look for them. But with a more advanced algorithm like ours that learns as it goes along, it's actually a lot more like putting multiple smaller umbrellas into the market. So we'll try to target a much wider spectrum of good conditions, not just the ones that are clustered most densely. And because each umbrella is smaller and more targeted to that specific cluster of good conditions, it captures fewer of the bad trades that are nearby. And the net result is more profits, a higher win rate, fewer losing streaks, and less drawdown. There will still be losses and bad trades. This is far from perfect. It's a robot, but I think you can hopefully see what a significant advancement this is in automated trading, and you're as excited about the possibilities that it offers as I am. As I said, the algorithm that does all this is located on our own database. We then use a plugin that's installed in our MT4 trading platforms that connects to that central server. And when the algorithm identifies a valid trade opportunity, it sends the signal to the platforms where the trade is then executed. So think of it as a master and slaves. The master program does the advanced analysis and makes decisions, and the slave programs do what they're told and manage the entries and exits in your account. And what this means for you is you can let it manage everything for you. Trade markets that you wouldn't normally be able to trade and take the emotion out of it that usually causes you to break the rules and be inconsistent. You're involved in Forex because you want to make money, and for most traders, there's no better, easier, or more reliable way to do that than using an automated strategy. Even basic robots are, perhaps sadly, better than 98% of traders. And we've got a really advanced system here. So I want you to be able to use that and put profits in your account. However, I still also want to help you become a better trader. Ultimately, Complete Currency Trader is an education site, and we're geared to helping you become self-reliant. It's the reason we sell the tools and education that we do, rather than only selling robots or signals. You know that famous proverb that if you give a man a fish, you feed him for a day, but if you teach a man to fish, he can feed himself for a lifetime. Well, a robot is like handing you a fish by just giving you the individual trades. Our aim is to try and teach you to trade successfully for yourself and put you in that top 2% of genuinely professional traders. A robot can trade a system for you. A good human trader, which we would like you to become, can trade any system in any market at any time. With your skills, you can even design your own robots. And when you can do all of those things, you are in complete control of your own future, and you will never worry about things like recessions or losing your job or, what's your pension and so on. It's not just financial freedom. When you're a good trader, it is peace of mind. So rather than just use the robot to make profits, we're going to structure this so that it acts as a training tool as well. And I'm going to make a very quick comparison here to explain why most people fail and how we're going to attempt to fix that. Making money trading is very similar to losing weight dieting. Both have very simple formulas that mathematically guarantee your success when they're followed. To lose weight, consume fewer calories than you burn off. To make money, cut your losses and let your winners run. Now, I know there are other considerations that contribute to those things, but at the basic level, that's all you need. Countless traders, including myself, economists, statisticians over the years, have all proven time and again that you can actually use a coin flip to decide your entry at random, and you can still be profitable as long as you cut your losses and you let your winners run. There are few things in life that are quite as simple and straightforward as losing weight or making money trading. But dieters and traders' failure rates are almost identical, and they both fail for more or less the same reasons. Both groups break the rules by giving in to temptation and impulses. Both groups have unrealistic expectations. They both get disheartened with their progress or their results. Neither accepts any responsibility for themselves, and they are both too quick to give up and go looking for something else. It boils down to failing because they don't stick to that proven formula for long enough. If a dieter stayed in a calorie deficit for a year, the only possible outcome is they would lose weight, guaranteed. If a trader stuck with a positive expectancy system for a year, the only possible outcome is a profit, guaranteed. But whereas people lack the motivation and the willpower to stick with things for long enough, a robot has got no such problem, and it will stick to it relentlessly for as long as it is told to. A robot trading for you is like someone else going on the diet and doing the hard work, but you actually losing the weight. And in trading terms, that has a profound effect. When you trade manually and you take some losses, consciously, you might say to yourself, look, this is okay, it's normal, I understand odds and probabilities, this is going to work in the long run, don't worry. But your subconscious is saying, nonsense. I've got absolutely no evidence or proof in front of me that this system works. In fact, the evidence I'm looking at is actually telling me that this doesn't work. So let's change something. And believe me, your subconscious mind is always going to win that argument. But unlike manual trading, a robot hasn't got a subconscious, and it is going to keep going and steadily provide the proof in your own account that you need. And as it's running on your account, your subconscious is casually keeping an eye on it and steadily noticing that it is working and it is growing the account regardless of temporary ups and downs or temporary losing streaks and drawdowns. And as more and more evidence over time builds up in the form of more and more trades being taken, the more you as a person will begin to trust that trading works. And eventually your subconscious will completely trust that this is a reliable way to make money. It is one of the ironies of trading that seeing success in someone else's account or reading about it in a book or looking at a video really doesn't matter. You need to see it in your own account before you properly believe it. If you don't believe it, you won't do it. And if you don't do it, you won't get the evidence you need to believe it. And of course, you end up in that vicious cycle of losing. But as soon as you get the evidence from the robot in your own account, you do begin to believe. And once you believe, it becomes easier and easier to do it manually, and you can make more and more money for yourself. Watching a robot trade can actually help you overcome the common emotions that usually cause traders to fail. So the trick is to use a robot to help you gather the proof in your own account. And that is the key. It needs to be in your own account. You don't need the discipline to stick to the system yourself. You just need the discipline to leave the robot running to do it all for you. And at the end of this, the benefit is not just that you will have a profitable account. Most people are trying to make a ton of money quickly from day one. But before you can make a lot of money, you need to be able to make some money. Just be profitable consistently, no matter how small that is. The key is consistently. When you can do that, you have options. You can use the Kelly formula to find out what your optimal position size to maximize your return safely is. You can get funded as a trader with a prop firm. You can trade a copy provider using companies like MyFXBook, and you can earn a kickback from every trade that you take. You can be a money manager with PAM or MAM accounts, or you can get outside investment to fund your own investment company. So in other words, once you show that you are consistently profitable, even with a small account, you can get rich by leveraging other people's money. In fact, every successful rich trader that I know or have heard of has done this. No one gets rich from growing their own small account. They get profitable with their own small account, and then they leverage other people's money to grow their wealth and become rich. The robot will help you achieve that important first step, and then I hope that it will open those doors for you. Now, the system it's trading is not 1,000 miles per hour scalping, so don't expect dozens of trades every day. This is very selective and cautious, and is designed to mimic my style of trading. And my style of trading is low risk and cautious. The robot is only going to trade the London and New York markets, so it won't take any positions during the Asian hours, and typically it will only open one position at a time. The idea is that all new trends start on the lower time frames. So the robot looks for high probability entries intraday using 1 minute and 5 minute charts with an average stop loss of between 20 and 30 pips. If the price doesn't continue the way we want it to, obviously we'll take a loss, but that loss will only ever be a maximum of 1% of the account balance, and usually we can reduce that as the conditions change, so the losses are even smaller. Every trade is opened with a risk of just 1% to the account. However, when the price does go into profit, the robot will trail the stop up quickly to lock us into a risk-free trade, and once we're in that position, we try to gradually scale up to the higher time frames. So we initially enter on a 5 minute chart using a multiple of 3 times the average true range to get the distance of our stop loss. Once that trails up and the trade is risk-free, in other words, the stop loss gets to break even, we then switch up to the 15 minute charts. And then we begin trailing the stop loss again using the wider average true range on this higher time frame until that goes past wherever the previous 5 minute best position was. And every time the new ATR distance improves on the previous one, we jump up to the next higher time frame. And eventually we could end up on the daily charts, maybe 500 pips in profit, trailing our stop loss 150 pips behind the price, despite the fact that we entered with only a 20 or 30 pip stop loss initially on a lower time frame. The idea is to enter highly targeted trades with tight stop losses and then follow the long-term trend. And what this means is sometimes we will hit massive winners. Last year, following this strategy, at one point, I had 3 trades open that were giving me over 60% profit on my account. And what this means for your equity curve is it will spend most periods appearing to go sideways and not much happening. There'll be some small wins, there'll be some small losses, not much happening, probably for several days, maybe even a couple of weeks. But then all of a sudden we hit a massive trend and we get a big jump up, and that pushes the equity curve up. And over time, what that actually looks like is the equity curve looking like a staircase. So it's got long flat periods followed by an almost vertical steep jump up, and so on, then followed by flat, another steep jump up. All in all, you are looking at a strategy that takes a limited number of high probability trades with minimal risk and aims to capture the biggest profits possible. Don't expect it to be trying to capture every single move throughout the day. There are going to be loads of trends that this completely misses. It's not looking for every move. We're just trying to make money as safely and reliably as possible with minimum risk. So we're not trading for entertainment or to keep ourselves busy or to have something to look at on our phones. This is going to sit patiently and miss out on lots and lots of moves because it is waiting patiently for the best moves that offer us the most in terms of profit and safety. By the end of the year, we would expect this to be in high double-digit, potentially triple-digit returns. I made 85% return last year doing my manual trading, and I only traded 7 months because I had a lot of time away from the markets for personal reasons. The robot is designed to trade with the same kind of approach. And although the entries are unlikely to be as good as mine, probably there will be fewer of them, but we're still expecting similar overall performance due to it being able to trade more hours. These are some of the back tests from 2018 to give you an idea of the potential results. And let me just stress that because these are hypothetical results that might have been possible in the past, it isn't a guarantee that we're going to get the same results in the future. I know you know that, but I need to repeat that just in case. So what we did was had to test each of the individual pairs separately because of the way the data is stored. So by themselves, each pair may not seem like much. But remember, we're not trading pairs. We're trading the whole market. And when you combine all of those results for a full year into cumulative returns, it is outstanding. Now, we are not going to get those results in live trading because in the live markets, we're not going to be overexposing ourselves to risk. So if we take a trade on the pound US dollar, for example, we're not also going to be in 7 other pairs that may have been open in backtesting. If 10 simultaneous open positions all lost, which can happen, well, you've all of a sudden lost 10% in one go. And our main aim with this robot is safety and looking after your account equity. Yes, there is massive reward potential trading everything at the same time, but with high reward comes higher risk and much bigger drawdown. I think that the cumulative drawdown for this backtesting would have been around about the 40% mark, which I think is unacceptable for a sensible trading strategy. But even so, you can see the potential here is massive. Even if a fraction of those results, it's still excellent and it's very promising. Certainly better than 98% of traders ever achieve on their own. Now, I'm not exactly sure what we're going to get in 2019 because it's the future and we don't know what the future is going to bring. But I am very confident that this is going to be a very good year and I'm really looking forward to it. I am now trading with this robot on my own account because I trust it so much. So if you want to use the robot, first of all, there is a slightly bigger upfront investment cost with this, although over the long run, it is cheaper than the monthly subscription. When you're invested, you are more committed and you are more likely to stick with it and succeed. Now, we've given tools and education away for free in the past, and we actually get terrible results because when people aren't invested, they don't take much notice of what they've got. When we put a price tag on exactly the same products, we get fantastic results. The only difference was that people paid, and that had the psychological effect of making them take it more seriously. So for your benefit as well as ours, we are going to ask you to invest and commit to this properly. After all, we are trying to make you a long-term profitable trader, and we want to make sure you succeed and don't quit, which is what makes most people fail. They just give up too easily. It's just less than $1,000 for the full year, which is about the same as a daily large cup of coffee from Starbucks. Depending on the size of the account that you have, it's likely that you're going to make that back several times over. So it's an extremely good investment. We've also got a couple of other techniques to try and help motivate you. We're running this as a 12-month program. It is not a week-by-week or month-by-month exercise. This is a 1-year challenge, and I'm going to be doing it alongside you. I'll send you an email every single day to confirm the trades, and then every Friday I'll do a recap video to talk you through each of the trades that we've been taking that week and discuss the patterns and look at what triggered the entry and how each position has been managed and why it was managed that way. So those videos will be part of your ongoing trader education. And then on the last day of each month, I'll do a review video to assess the results and the progress for the entire month, as well as the cumulative returns as we get further and further into the process. So altogether, this is going to be a much more focused process than anything that we've done before. Rather than you doing your trades and then me doing a different set of trades at a different time and then talking about it afterwards, we're all going to be on the same page, watching the same trades in real time, getting the same results, so you'll profit while I profit, and we're going to be learning from the same situations. And I think that'll create far more uniformity about what we're doing. Let's all go through this together. Also, for every month that you leave the robot running to trade for you, you'll be given an entry into a free prize draw for a brand new top-of-the-range trading computer with multiple monitors. So if you stick at this for 12 months, you will have 12 separate entries, and we'll draw one person from the hat at random at the end of the year to be the winner. We're doing everything that we possibly can to make sure you get the results and stick to this and you do become successful. Now, there's a second link underneath this video that you can use right now to sign up for the robot if you prefer this option instead of the manual tools that you control yourself. If you sign up to the robot, you'll get all of the information, the installation instructions immediately, and you can turn this on and you can get started straight away. So that is 2 options for you. You can either subscribe to the analysis tools and take charge of your own trading, and that's actually what I would recommend. However, there is also the robot option if you prefer that. The reason I recommend the manual tools is because using them, you will learn to trade for yourself more quickly, and that gives you more control and mastery over your own skills. But of course, learning to trade manually takes time and effort, and for some people, a robot is a better solution. So we are giving you both options so that you can choose which one is best for you right now. Of course, you can sign up to both. You can have the robot trading for you if you want, and sign up to the tools so that you can actually get the practice in and trade for yourself as well, and actually accelerate your learning far better in that manner. So I really hope you want to join us and begin using either or both of these options for yourself. At the very least, I hope the course this week has been worthwhile and an eye-opener for you. With any luck, you've had an education that you haven't had before, and you've learned the truth about Forex that will stay with you and help you no matter where your journey takes you in the future. Okay, so I won't take any more of your time right now. I appreciate you attending each of these lessons this week, and I welcome any feedback or questions you might have. All that's left is for you to use one or both of those links below to get started straight away. Thank you.